Well, I think he's on the right side of the story. And it's quite interesting to see what strategies have performed best this year. It's basically the trend following quantitative strategies, which performed very strongly, no surprise. And interestingly, also the short-long strategies have been pretty disastrous. And of course, needless to say, that long only has been the worst. So I think right now he's on the right side of this investment strategy, yes.
The history books tend to point to something like an average decline of 20 to 25% in a rate hiking cycle if markets take it badly here. I'm already starting to get reports from different investors saying we shouldn't be far away here from at least the US equity markets beginning to find a firmer bottom. Are they talking their own book, or do you think there is an argument for saying actually the markets have already taken on a lot of the pain in anticipation of what the Fed and other central banks are intending to do, and that we might find a bottom fairly soon, temporary or otherwise?
Well, I don't think that we are close to any bottom in the overall indices. And we cannot compare the average downturns of the last 40 years when we had basically a disinflationary trend since the Volcker time. We have a real complex macro situation now, unhinged inflation rates. And if you just look at the facts in the US market, that we have the long treasury below 3.5%, unemployment below 4%, inflation rates above 8%, real interest rates have hardly moved. And if you look at risk indicators like volatility index, credit spreads, default rates, they're not even halfway gone where they should be in order to form a proper bear market bottom. So there's a lot of deleveraging still to go on. But that's for the major indexes. Of course, if you look into the market, then you see vast divergences in performances and loss-making technology, and then small and medium cap stocks, meme stocks, and of course cryptos. They have either lost between 50 and 70% already, or they have entirely collapsed. So a lot of the heat is being addressed right now. But, you know, the key indicator here, I still think, is high yield debt spreads and default rates. And they have simply not reached territory which is at any stage here interesting to invest in. So the pain will go on for quite a while.
Bayat, a very good morning to you, my friend. In terms of the competition for the dullest central bank in terms of monetary policy, possibly the SNB was winning that award for the last 6.5 years. But now Thomas Jordan has just gone to the front of the pack of the most exciting central bankers out there as well. What do you make of it? Because I don't think it was the ECB, the Fed, the BOE that really surprised people. I think it was Thomas Jordan. I think it was the SNB yesterday. What does it tell us about inflation in Europe and where policy could go next?
Well, I'm a bit surprised that everybody seems to be surprised by the SNB's move yesterday, which in my view was overdue, but timely, and there's certainly more to come. What it tells us in the larger global context is that the Swiss, who have been lagging for good reasons, they have joined the global tightening bandwagon, and they will, of course, be oriented toward what is going on at the Fed and the ECB. And there will be more steps to be taken. And, you know, beyond the short-term noise, this is a very healthy step. We complain now about losses and volatilities in markets and fragmentation in the Eurozone. But basically, we have to get the global economy back on a normalized track where the basic economic key indicators are in equilibrium with each other. So markets are now forcing the hands of politicians until the decisions get taken, cyclical, but most importantly structural, to get to a healthy new growth cycle. And there are lots of pockets for structural growth. And so the message from the SNB yesterday is, yes, we also joined the bandwagon, and therefore this global monetary tightening cycle has really now quite some way to go until we see inflation trending down. But let's not get fooled. Soft landing is a wishful thinking, and to get back to a target rate of the central banks at 2%, we are very far away.